From New York City for our viewer worldwide, I'm Lisa Abramowicz in for Jonathan Ferro. Right now, we are looking at complete stasis as the world watches to try to understand what's going on with Russia. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Coming up, markets on edge with traders preparing for the second half as fresh geopolitical uncertainty emerges out of Russia and global central bankers warn of more rate hikes. We begin with the big issue, investors digesting the rebellion in Russia.
It's been a roller coaster weekend.
The issue is around Putin.
A lot of uncertainty.
Uncertainty on the Russian side.
Uncertainty, volatility for the markets.
Traders this morning just acting a little bit on the side of caution.
There is a real air of caution and pause.
There is certainly a negative indirect impact that we have seen. Market reaction very muted.
Markets now need to contemplate what the future holds.
The longer-term ramifications.
There is some doubts.
Some worries perhaps about supply.
We could see a surge in commodity prices.
This is all very fluid.
A massive chess game, geopolitical chess game.
If escalation were to increase, things could change.
I don't really think anyone really knows what the next move is going to be.
We don't have a clue about what can happen next.
Bloomberg's Maria Tadeo and Anne-Marie Hordern joining us now with more. Maria, I know you've been speaking with people over in Europe. Where is the main concern right now? Where is the balance of logic where people are basically honing in on in terms of the ramifications of what we saw over the weekend?
Look, there's a lot of question marks in terms of this deal. And the deal, of course, I referred to that alleged compromise that was reached out on the Saturday and negotiated by the head of Belarus, Alexander Lukashenko, between Vladimir Putin and Prigozhin. This deal is a reason fundamentally why Prigozhin and Wagner allegedly pulled back from Moscow. And the idea is that nobody would be prosecuted. There would be a sort of amnesty and Prigozhin would head to Belarus, which, of course, is an independent, in theory, a separate country to Russia. Now, today, the Russian state media, however, says that they have not dropped the investigation into mutiny, and there are serious questions as to where it is or what are the whereabouts of Prigozhin. I think the other big quick question, that was made clear by the Secretary General today is this has ramifications in terms of what happens with Wagner and this group of mercenaries, which not only operate in Ukraine, but in a number of places in the world. The Secretary General also repeated, this is what happens when you have mercenaries fighting your war. And again, a message for NATO as far as NATO is concerned. The key point now is to keep supporting Ukraine at this stage. Whatever they need, allies should now provide it.
And Marie, how much in Washington, D.C. is that the takeaway, that this gives Ukraine an advantage and to continue doubling down at this point? Or are you hearing a slightly different tone from the people in D.C.?
Well, I think Washington administration does think this opens the door a bit more for Ukraine to make strategic advances when it comes to Putin's invasion of their country, specifically because now, as Secretary of State Antony Blinken put in a number of Sunday shows over the weekend, now what you have is Putin dealing with tension and the most serious threat we have seen on him and his power since he came to power than he ever has. So he is dealing with a lot of internal politics. Many and what we play over the weekend was chaotic, a spectacle. Russians also lost their lives in what happened over the weekend. So now Putin's attention is going to have to be split. And that is why they think there's potentially this opening for Ukraine. But as Maria says, there are a number of questions that still remain unanswered regarding what happened in terms of this deal and where does this leave Putin and his military. Some analysts I'm speaking to also say potentially this will mean that Putin is going to become even more of a hardliner and really double down his aggression in Ukraine.
Which is the reason why Ian Bremmer was talking about the nuclear stash and was concerned about it. Maria Tadeo in Brussels and Marie Hordern from Washington, D.C. A fabulous team. Thank you so much for that update. Let's continue the conversation now with J.P. Morgan's Stephanie Roth and John Mackay of Schroders. John, how much are you shifting any of your views based on what we saw over the weekend in Russia?
I think it's a very, very hard thing to do. It's a great question, Lisa, and thanks for having me on. I think probably the easiest thing you could do at the margin is maybe increase commodity exposure. Gold obviously is always a good geopolitical hedge. Geopolitics generally doesn't matter until it does, and it obviously mattered a lot over the weekend. It seems to have abated as news has emerged that obviously Prigozhin has removed himself and gone across the border. But I think Anne-Marie hit the nail on the head, right? This could, increase the likelihood that Putin does something more aggressive, at the very least weakens his hold on Russia. So I think commodities are probably the easiest thing you can do at the margin to hedge a continued rise in geopolitical risks.
This is a key question, Stephanie. At what point do we see some sort of inflationary or disinflationary force from this type of conflict if Ukraine possibly has an upper hand in the conflict, or alternatively, some sort of ongoing conflict in Russia really does take barrels of oil off the market?
Yeah, it could certainly have an inflationary impact from a headline CPI perspective, but it would also at the margin slow down growth in the future. And I think the really important message for investors is adding core duration fixed income really makes sense here, because recession risks are rising. They've been elevated for quite some time, and this is just another reason to be more defensive in portfolio positioning.
That is something that I know Morgan Stanley's Mike Wilson has been agreeing with for quite a while. He warned over the weekend that U.S. equities face a wall of worry, writing, quote, "The headwinds significantly outweigh the tailwinds, and we believe risks for a major correction have rarely been higher. We believe the next leg will be about deteriorating pricing and top-line disappointment." John, we heard Stephanie there basically agreeing with a sort of defensive positioning, albeit not necessarily with exactly this call. John, do you see it the same way?
We do. And look, I think Mike wrote that note, and I'm making a bit of an assumption here, but I think he wrote that note before knowing that there was this attempted coup attempt in Russia. So I think at the margin, the reasons he's citing are fundamentals are going to deteriorate over the remainder of this year. The price you're getting paid for the fundamental outlook is not good. And so you need to reduce exposure. I'm sure there's plenty of other reasons he cites in that report, and we would agree with that. I think if you look back at the beginning of this year, obviously the outlook was pretty bearish. I think sentiment has shifted quite a bit to quite a bullish outlook, hopes for a soft landing, and we don't agree with that. We still think a recession risk is fairly high in the U.S. It's been pushed out a little bit given the strength of the consumer, but it's still probably going to happen in the fourth quarter of this year, and a recession will lead to weaker earnings, and you're trading at 19.5, almost 20 times future earnings. On the S&P, you're not getting compensated for that risk. But I would say, and we have been saying for the past year plus, is this new environment, this new regime we're in of higher, stickier inflation means you need greater diversification. And I know that sounds like shoulder shrug, we've heard that before, but you've seen markets like Japan do extraordinarily well this year, and sort of it's a forgotten market. No one's talking about it much. The DAX, the CAC 40, Germany and France have done better than the U.S. this year. So spreading your bets a little bit in this time of uncertainty, we think makes a ton of sense.
Stephanie, from your vantage point, you were talking about some sort of slowdown and the need to be defensive. What are you looking at to determine that at a time when Carl Weinberg of High Frequency Economics earlier this morning on Bloomberg Surveillance said that he is the most positive on the U.S. economy going back to the 1960s because of employment and the strength of the consumer?
I think it's hard to be really positive looking forward because the Fed is trying to engineer a slowdown. So they're raising rates, keeping them elevated at above 5% for quite some time, and that's going to have an impact. They're going to get a slowdown one way or another. And if we don't get that slowdown, the Fed's just going to have to keep hiking. So risks remain quite high. But we are getting closer to the Fed pause, which is an important thing. So what are we looking at there? Employment needs to slow down into the 100s. It's currently around 200,000. We need to see continued signs that rates are restrictive. That's the case. Banks lending has certainly slowed down from where we were last year. And we need to see continued signs that inflation is cooling down. So we've gotten some of that. I think claims are going to be the most important thing to watch. They have certainly risen over the course of this year, and that's one important sign of cracks under the surface.
And John, this is the reason why diversification becomes so complicated, as I'm sure everyone's been talking about. But you say that it's important to diversify your portfolio, and yet if the Fed, if the ECB, if the Bank of England, if the Bank of Japan, or not the Bank of Japan, they're their own story, but the rest of them who are meeting in Sintra this week are talking about the potential for higher rates for longer, then are bonds truly a diversifier at a time when stocks, as you say, look a bit heady in valuation?
We think they are. I mean, the yield you were getting paid at the beginning of last year didn't compensate you for higher yields, right? The risk of rates rising, you're getting compensated for that now. So the impact of if we're wrong and if a slowdown doesn't happen and the Fed keeps rates higher for longer, along with other central banks, and rates rise from here, it'll hurt, but it's not going to hurt you nearly as much as it did last year. So we would agree with Stephanie. We think it's worth taking on some duration. The other thing I'd keep in mind is at the beginning of last year, obviously Fed funds were at zero, 10-year Treasury yields were significantly lower than they are today. The market sold off on the fear of rising rates having an impact on the economy. We now have those higher rates, and everyone's kind of blasé about the impact on the economy. It just doesn't make much sense. Those two things just don't, they don't tie together. So our view is get slower growth. That should result in longer yields, probably falling a little bit further from here. But I think the key there is they're not going to fall back to zero. We're not in this environment anymore where the Fed's going to be able to step in. You see weakness in the economy, weakness in the markets, and they cut rates immediately because of higher inflation. So it's a much more difficult environment than we've been in for quite some time.
Stephanie Roth, John Mackay, both of you are sticking with us. Let's take a look right now at some of the stocks moving ahead of the opening bell. Abigail Doolittle joining us. Abby.
Hey, Lisa. Well, overall, we have stock futures basically unchanged, down ever so slightly. But to the upside, PacWest, they sold $3.5 billion worth of asset-backed loan portfolio to Ares Management, boosting the company's liquidity amid continued concerns on deposit outflows. Lucid also higher, sharply higher, up nearly by 9%. Aston Martin joins with Lucid in a Saudi-backed EV partnership, has also sent Aston Martin soaring on the possibility of something new for both of these companies. And then finally, Tesla, not so much, down 1.9%. One of the big drags on the market this morning, cut to a neutral from a buy at Goldman Sachs on a tough pricing environment. Plus, as you know, Lisa, this stock has already more than doubled in 2023.
Just some small gains. Abigail, thank you. Coming up, central bankers warning of more rate hikes.
Inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go.
That conversation coming up next from New York. This is Bloomberg.
Inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go.
Additional policy rate increases will be necessary to bring inflation down to our target over time.
We're very far from our inflation target of 2%.
I expect that we will need to increase the federal funds rate further to achieve a sufficiently restrictive stance of monetary policy.
It will be appropriate to raise interest rates somewhat further by the end of the year.
Fed officials ramping up the hawkish rhetoric as Governor Bowman calls for better supervision of U.S. banks ahead of their stress tests that come out on Wednesday, saying, quote, we need to consider whether examiners have the appropriate tools and support to identify important issues and demand prompt remediation. Increasing capital requirements simply does not get at this underlying concern about the effectiveness of supervision. Bloomberg's Ira Jersey joining us now for more ahead of a very busy week, particularly on the central banking front. And if it weren't for Russia, Ira, we'd be talking about Sintra and how all the central bankers, the major ones from around the world, are getting together. What are you looking for in terms of a united hawkish message from these central bankers coming out on Wednesday?
Yeah, I think with the UK and the US seeming like they're going to hike a little bit more, it'll be interesting to see what the ECB and some of the other developed market central banks suggest at some of these discussions that they're having. I think from a market perspective, it's interesting that some of the most important information we're going to get is going to be in the middle of the night in the U.S. So, for example, Powell this week at one of the panels he's going to be on is going to be on at 2:30 in the morning, New York time. So, so a lot of the market moves may happen overnight. So we have to be aware that that when we come in the morning, we might see some pretty dramatic moves depending on how hawkish or seemingly dovish some of those comments might be.
Ira, what's your sense of the duration of how long these central banks want to hold rates high versus how high the rates are going to go? How unified they are in their belief that the duration is more important than simply the terminal level?
Well, I think there's two parts to that, Lisa. I think firstly that most central banks really want to make sure that inflation is trending lower toward their various targets, which for the most part is 2%, depending on which which measure of inflation that you're looking at. So for the Federal Reserve, I think that means that you're still looking at well into 2024 before we get there. And in the summary of economic projections, the Fed even doesn't think that they're going to get back to that 2% target till 2025. So the Fed might be pretty reluctant to start cutting interest rates at any point really in the next 18 months, unless it sees a very significant uptick on the unemployment rate or a significant reduction in inflation that seems like it's going to hit their target. So they've been trying to hit on that, but the market has not believed that the Federal Reserve and indeed some other central banks will be able to do that because the market seems to think that there'll either be an exogenous shock or that the economy will weaken enough that it'll start to that they'll be forced to actually cut interest rates earlier maybe than they would like to in some of their projections.
Ira Jersey, thank you so much. Still with us are Stephanie Roth and John Mackay. And there is this question as we talk about tightening policy, how far and for how long? Stephanie, you were talking about how they do want to kill some of the momentum in the economy. They want to induce some sort of downturn. Why do you think this economy has been so resilient to higher rates so far this year?
I think it's been partially driven by the consumer, and this is all related to the labor market. The labor market has been really, really strong, largely driven by the service sector, so leisure and hospitality. That's been a really important driver, and until you start to see a real weakening in the labor market, the consumer is going to just keep spending. And on top of that, they've started to take out a little bit of debt. So you've seen credit card loans pick up a little bit. So once you do start to see weakening in the labor market, then the economy will slow down and get the Fed what it needs. We're just not really there yet.
Do you think it's a matter of how long, Stephanie, they hold rates high, or do you think that it's getting to a much higher terminal rate than people previously expected?
I think it's keeping rates at a restrictive level. I don't think they need to hike that much more, but potentially just one more time. But keeping rates at a restrictive level, we're starting to see signs that restrictive rates are having an impact. And they just need to stay there for a little bit more time. So while housing is bouncing a little bit, still at weak levels, manufacturing activity has really gotten hit pretty hard recently. And then it's really just a matter of the labor market starting to cool as a result of companies realizing that nominal growth for their companies have slowed down below where interest rates are.
John, do you think that people underestimated just how much resilience was baked into the economy and how long some of these loans were? I'm thinking of mortgages for 30 years that no one is really paying 7 or 8% on their mortgage, or very few. Is that the reason why there is going to be a resiliency for much longer than people previously expected?
Yeah, I would agree with a lot of what Stephanie just said, right? It's the strength of the consumer, the health of the balance sheets, obviously coming out of hopefully a once-in-a-100-year pandemic, which resulted in massive amounts of fiscal stimulus, most of which went directly to consumers' balance sheets, and consumers weren't spending during that time. Now they're coming out, they're spending more, interest rates have moved higher, and there is this lagged effect. You know, some people say it's 6 months, some 12, some 18 months, but I do think you've seen sort of these weird knock-on effects that no one sort of expected coming out of a higher interest rate environment. Home builders, for example, doing extraordinarily well because existing homeowners don't want to sell because they've got a 3 or 3.5 or a 4% 30-year mortgage. That they're just not gonna want to trade, you know, I don't know how to say it, up to a 5 or 6 or 7% mortgage for a new house. They'll stay in their homes for longer. So that takes supply out of the market. And so there's all these knock-on effects that I just don't think people fully understood or fully appreciated, but I think to some degree have allowed the economy to be stronger than expected. Obviously the labor market as well, which Stephanie already covered.
Michelle Bowman was talking over the weekend about stress tests and the need for greater supervision, not necessarily more capital held by the biggest banks. From your vantage point, John, do you think this has been the main sort of hold back for the Fed for why they're not taking rates even higher right now? They want to get a better handle on the financial system and where some of the vulnerabilities might be.
Perhaps. I think it's potentially a little bit of that, but I think it's also, and look, that mattered a lot more 3 months ago when you had the potential for a sort of cascading effect amongst the banking system, which we haven't seen, thank God, because of some of the measures that the Fed put in place. But I think it's also just the lagged effect of hiking 500 basis points in, you know, a little over a year and seeing what the impact is on markets. And again, going back to agreeing with Stephanie here, it doesn't really matter whether they hike another 25 bips, 50 bips, or 75 bips. I think what really matters is how long are they going to stick with rates at these levels and see what the impact on the economy is. I think that's the primary driver of the Fed sort of pausing here.
Stephanie, as we head toward those stress tests on Wednesday, is the banking crisis over?
I think the crisis is over, but the slow burn on the economy is probably not. So really what this means is just banks are going to pull back on lending. We've already seen that. And it's just going to be a continued tightening of conditions in the economy this year. Bank loan growth has slowed down to about 3% on an annualized basis versus 7 or 8 or 9% last year. So it's going to be a slow burn weakness heading in the economy this year rather than a crisis. That part is probably over.
Which types of the economy, Stephanie, do you think will be most affected by the withdrawal of liquidity or the withdrawal of credit from some of the bigger banks?
So the bigger banks are a little bit less exposed to the commercial real estate side. That's on the small banks. So you'll probably see it in C&I loans and certainly consumer loans. That banks will probably start pulling back and tightening standards there, and that's what will get us that needed slowdown in the consumer.
John, do you think that that's going to pressure credit at all, or do you think that that'll bolster certain areas of it where the public and the private credit markets take up some of the slack from the financial institutions?
I think the private credit markets are going to have a hard time doing that. In a zero interest rate environment, capital was pouring into those strategies, giving a lot of weight to the impact they would have on the lending markets. I think that that trade is dwindling. It's diminishing a little bit. And so I think, coupled with higher interest rates, and obviously you're seeing delinquencies rise as well. We've seen that so far this year. Obviously, the problems in the commercial real estate market have been well covered. Banks will pull back. Private lenders will also pull back. And that will lead to, a slowdown in consumer spending and a slowdown to economic activity.
Stephanie Roth, John Mackay, both of you, thank you so much. Meanwhile, earnings from Carnival just crossing the terminal. Bloomberg's Abigail Doolittle has the latest. Abigail.
Well, Lisa, it's really interesting because this stock in the pre-market had been up more than 2%. Now it is down nearly 4%. So on an intraday pre-market basis, a 6% move, a big reversal, having to do, I believe, with a miss relative to the current quarter guide on adjusted EBITDA. They're looking for $2.05 billion to $2.15 billion, the estimate of 2.09. So it's the low end is missing that. Relative to the quarter they reported, they beat sales. The loss was narrower than expected. They're seeing very strong demand in the second quarter with total bookings reaching records for all sailings. So some mixed messages. I think that the backdrop, though, Lisa, that we need to understand, up nearly 100% on the year, expecting perfection, not quite there.
Abigail, thank you. Coming up, the morning calls, and later, closing out the first half of 2023. We're looking back and looking ahead with Troy Gajewski of FS Investments. That conversation still ahead. This is Bloomberg. Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Goldman Sachs downgrading Tesla to neutral, highlighting the challenging pricing environment. Next up, UBS downgrading Alphabet to neutral, expecting limited upside due to monetization risks with AI. And finally, BMO upgrading Sherwin-Williams to outperform, seeing encouraging trends from the housing market. Coming up, Troy Gajewski joining us of FS Investments. This is Bloomberg. This is Countdown to the Open. I'm Lisa Abramowicz in for Jonathan Farrow. Moments away from the start of trading, and the stasis that we saw earlier in the day has turned into a bit of softness, a bit of red across the board as people reassess the risk of what happened in Russia. About 0.1%, almost 0.2% decline at the S&P and the Russell. We're still seeing a bit of a bid into bonds. We are seeing people look at this to a haven, but less so than before. 10-year yields at 3.71%. A bit of euro strength, ironically, after especially a lot of people concerned about what potential risks there could be. It has settled out with a bit of dollar weakness and euro strength, and crude still lower by about 0.4%. One stock to watch at the open, Carnival Cruise Lines. The company out with earnings just moments ago, facing high expectations with the stock nearly doubling this year alone. Melius Research weighing in ahead of the results, writing, quote, following the recent move in shares, Carnival has a lot to live up to, and that seems to be the response. Bloomberg's Abigail Doolittle joining us now with more. Abigail.
Yeah, price to perfection, and investors not thinking that the results and the outlook are perfection. The stock right now down more than 8%. Its worst day since November of last year. Now, of course, ahead of this report, it had been up almost 100% on the year. So again, that idea, not quite what investors were expecting. But it's interesting because it doesn't seem so flawed from a surface view, Lisa. They put up a narrower loss than expected. They beat revenues. They put up $4.91 billion, almost 3% better. They're talking about an acceleration of demand in the second quarter, total bookings reaching records of all sailings. The one big flaw that I can see is the EBITDA, the adjusted EBITDA guidance for the current quarter. The low end is a little bit below the estimate, so perhaps investors seeing some weakness there. The conference call starts at 10 a.m., so perhaps there will be more color that will come out that some investors are already seeing. But again, this stock down 8%, its worst day of the year. Investors not getting what they were expecting, and some of the other cruise operators also down in sympathy.
Abigail Doolittle, thank you so much. Turning now to the financials. Goldman Sachs is said to be cutting a number of managing directors across the globe as it confronts a slowdown in deal making. The latest moves coinciding with recent reductions at JP Morgan and Citigroup as well. Joining us now, I'm so pleased to say, is Bloomberg's Sonali Basak. Sonali.
We're looking at about 125 managing directors, Lisa, being cut over at Goldman Sachs. These are more senior positions, including in investment banking after a prolonged deal slump. Now, we know that deals are starting to come back. It certainly is a merger Monday as we see it today. But again, remember how much these banks have hired. This year is almost halfway through, and you're not seeing a jump back enough to justify so many of the jobs that have been brought on in recent years. Over at JP Morgan, that cut number is about 40 people across different levels of seniority. You have another 20 bankers over in Asia also facing job cuts. And then you have Citigroup looking at dozens as well, both in investment banking over in the United States, as well as corporate banking over in London. So you are seeing banks starting to nip at the heels of their workforce in multiple layers of job cuts. Now, I would also say there's a lot of uncertainty about how this year continues to unravel. We are seeing some of the very top ranks also move around a lot and jump to rivals as well. So not all is bad news, but it is a tense time on Wall Street, and we are seeing people look for new jobs at the same time, both in trading and in investment banking.
Sonali Basak, thank you so much. And turning now to big tech, the NASDAQ 100 looking to rebound from its biggest weekly decline since March, and getting no help from Wall Street with both Tesla and Alphabet on the receiving end of analyst downgrades this morning. Joining us now, Bloomberg's Ed Ludlow from San Francisco. Ed, some downgrades from the likes of Alphabet and Tesla.
Yeah, good morning, Lisa. Let's start with Alphabet, the parent company of Google. UBS downgrading to neutral from buy. In the near term, monetization risks. In the medium term, they're talking about revenue risk from new generative AI-powered search results displacing ad inventory. Among the mega cap names that UBS likes, they prefer Amazon and Meta, both of which have a buy rating with better risk-reward profiles than Alphabet. Tesla also a really interesting one. Goldman, the latest name to downgrade the stock to neutral from buy. Two factors. One, the surge in the stock that we've seen, and you and I have been discussing for what seems like weeks and months now. But two, they also note the declining average price of new vehicles from Tesla. It's the fourth downgrade that I can see, at least in the last week. Morgan Stanley, Barclays, and DZ have all downgraded their calls on Tesla. But remember, this is a stock that's up more than 100% year to date. Kind of zooming out just really quick in the NASDAQ 100, like the rest of the market, we're coming off the biggest weekly decline since March, that week where we had the banking crisis unfold. We saw this move into bonds, Thursday, Friday. I kind of think there's still a little bit of central bank rates, inflation, and what it means for some of the valuations on the NASDAQ 100 in terms of single names going forward.
Ed Ludlow, thank you so much. Sticking with tech, Permabull Dan Ives of Wedbush expecting the sector to continue its outperformance, writing, quote, heading into the second half of 2023, we see a much broader tech rally ahead as investors further digest the ramifications of this $800 billion AI spending wave on the horizon and what this means for the software, chip, hardware, and tech ecosystem over the next year. Joining us now, Troy Gajewski of FS Investments. Troy, so great to see you. It has been too long. Do you agree that this does seem to be an area that, even though it has been highly valued so far this year, has a lot more room to go?
Well, I think over the next 5-7 years, for sure. The issue in the shorter term, though, Lisa, as we've discussed, is that we're entering a period of market history where you're having the greatest liquidity suck of all time, in that the Fed is back to doing aggressive QT and draining the balance sheet. Remember, at close to 5 times what they did in the last QT, while banking lending has completely stagnated now. When the Treasury is replenishing their checkbook and issuing T-bills, notes, and bonds at a very furious rate. So, back to the points you guys made on Carnival, there are a lot of expectations baked into that share price appreciation, just like there have been in tech. And AI is certainly for real. It will drive revenue. It already has, obviously, in NVIDIA. But is it enough to overcome very elevated multiples at a time where recession risk is the highest it's been since the dark days of the pandemic, when you're having this tremendous exodus of liquidity from broader markets? So in our estimation, the risk reward of being long equities at these valuations is not attractive at all.
It pains me a little bit to put Carnival and NVIDIA in the same sentence in some sort of comparison.
It does, right?
It just doesn't feel quite right. But I'm wondering if that is the parable here, that basically the idea that Carnival had been bid up and priced to perfection to such a degree that even beating results, even beating analysts' expectations wasn't enough to stem some pretty significant declines. Do you think that's a playbook for what we're going to get from Alphabet and Google, Alphabet and Amazon, and potentially even Tesla?
Well, I think it's more, we're sort of reverted back to this late 21 period where markets were moved from pricing tech at forward cash flows, because they are cash flow monsters, to back to price to sales again. And we thought that we'd extinguish that last year with obviously the dramatic revaluations. But anytime you're buying an equity or any security on price to sales that are extremely elevated, it's just very difficult to get the organic growth that you need to justify that. Again, particularly at a time where recession risk is set arguably 70 to 80%, and you're having such a drain of liquidity. So, the strongest rallies are always in bear markets. We still believe this is a very powerful bear market rally, and it will ultimately make lower lows. But again, the good news, Lisa, is we're not going to have a repeat of 2008. We're certainly not going to have a bear market as bad as 2002. It's just we've priced all the good news in, and it's really hard to get overly optimistic about expected returns being long beta right here.
How long have you been pessimistic, Troy? Because one thing, and Neil Dutta came out with a scathing note to all of the bears out there, basically saying, all right, if you're wrong for 6 months, you're just wrong. And I know that probably stings for a lot of people, including Mike Wilson, who we've been quoting all morning. But do you feel like that is the sign of a peak in terms of valuations, that people are all capitulating at this moment? Or do you think that that is something to pay attention to, that the bears have gotten it wrong?
Well, yeah, so capitulation cuts both ways. It's a great point. I mean, we've really been bearish since the end of 21, when it was very clear that, the Fed would have to hike aggressively. We didn't know how big QT would be, but we knew it would be a meaningful impact. And again, within bear markets, you do have very powerful rallies. Just go back to 2001 as an example, when the Fed had already started to cut, right? And then you had these monstrous bear market rallies. So capitulation cuts both ways. It reminds me of late last year, say September, October, when some of the few remaining perma bulls were starting to throw in the towel. And now you're starting to see people that we think are rationally cyclically bearish start to throw in the towel as well. Again, if the S&P was at 14 or 15 times forward earnings and recession risk was 10, 20%, we could have a different discussion. But S&P's back up to 19 plus forward earnings. Recession risk is much higher. And again, this is the first time in this bear market, which started in the beginning of 22, where you've had the Fed doing aggressive QT while bank lending has stagnated, while the Treasury is simultaneously pulling out $500 to $600 billion from markets in a very short period of time. So that just doesn't bode well from a risk-reward standpoint. But the great news here, Lisa, is there's still attractive things to do. It's the best time we've seen to be a private lender really since the global financial crisis. You need dry powder to take advantage of that, but whether it's senior secured commercial real estate lending, now you have middle market corporate lending where you're having 5 to 6% higher yields than as recently as 16, 18 months ago. There's things to do. You just don't want to be greedy. This is not a time for greed. This is a time for rational Northwest Quadrant efficient frontier investment strategies.
So, okay, just putting aside the people who are agreeing with you or saying, you know what, we're still bullish, how come someone couldn't listen to this and just say, well, this is, talking the book a little bit in the sense that let's go into some of these other instruments that aren't traded as frequently, so aren't going to reflect some declines. But at the same time, this has been an area where people view increasingly as diversification versus aren't they also going to sell off if we do see some sort of material sell off in the equity sector?
Yeah, so it's a good point, Elise, and that gets back to beta or sensitivity to broader equity markets. And remember, it's not just beta to equities, it's also beta to real estate. And so you really have to be focused on areas that are economically resilient to that downturn. Again, that's why you want to be in the senior part of the capital structure, so you have far less downside risk. While at the same time, because the Fed has already, hiked so aggressively, you're earning much higher yields than any of us dreamed of 18 months ago. So if you can make high single digits to even low teens with far less downside, again, if the S&P was at 12 or 11 times forward earnings, like it was, prior to QE3 and during the Eurozone crisis, you could argue both areas have attractive upside, but we're at elevated valuations for equities. High yield bond spreads are still relatively tight, and there are areas in markets now, a lot of it driven and exacerbated by the pullback in bank lending, where you can get equity-like returns with far less downside risk. And we just think that's a more intelligent way to position yourself at this stage of a cycle.
And it's probably something that Morgan Stanley's analysts would agree with. Morgan Stanley's Mike Wilson, we were talking about him earlier. He warned of a wall of worry facing off with equities, writing, quote, "The headwinds significantly outweigh the tailwinds, and we believe risks for a major correction have rarely been higher. We believe the next leg will be about deteriorating pricing and top-line disappointment." Troy, I know that you have been agreeing with that. So let's put some numbers around this. What type of correction could we be looking for? Where is it led by? And, how long could it potentially be?
Yeah, so look, to us, we've always thought of this bear market as much more mild than 2008 or the financial crisis or 2002, something in the order of 25 to 35% peak to trough as opposed to 50% or greater. We think a rational downside target, again, it's not going to stay there for months and quarters and years, but it's somewhere around 32 to 3,400 for the S&P, where, earnings drop to 200, you get a 16 to 17 multiple on that, which again is higher than the October multiple of last year. And that implies about 15 to 25% more downside from here. So certainly very, very painful. And the other part that's important here, Lisa, that I don't think is talked about enough is, if you could sit here today and say, hey, I have 5% upside in the S&P, I got 15 to 25% downside. But guess what? Coming out of it, I'm going to make 80 to 100% the next 3 to 4 years because the Fed's going to cut rates to zero and they're going to do another QE. Well, hey, maybe you could tolerate that short-term pain. But the next bull market is going to look a lot like 02 to 07, which was driven exclusively by earnings growth and not by zero interest rate policy, not by multiple rounds of QE, because we're not going to see another QE unless we have an economic or a market disaster, which at that point, you're going to be begging for the Fed to come in and bail everything out. So again, focus on Northwest Quadrant strategies, accept a modest return. High single digits to low teens, some would say, is better than modest, and make sure you have as little downside as possible, not if, but when the next recession begins late this year or early next year.
Troy, how have you explained some of your conservative positioning at a time when a lot of people are getting greedy?
Yeah, well, look, markets move in cycles and waves, and I think you have to have a consistent viewpoint on asset allocation, right? And what we're talking about here, big picture, is, most investors for 12, 13 years got very comfortable with equities appreciated north of 12, 15, 18%, and fixed income at least not getting devastated. Obviously, 2022 is the complete reverse of that. And now we've seen a short-term comeback in 60-40. But if you think the big picture here, Lisa, the big picture is the drivers of the dominance of equity returns, coupled with a period where bonds outperformed expectations. One was limitless money supply growth. That's obviously a headwind as far as the eye can see. The other was interest rates going lower and lower and lower, which justified higher prices for every asset. And then the third, of course, was the wonderful Chinese labor market, which helped boost corporate margins from 5.5% to over 13%.
Yeah.
All of those factors are no longer tailwinds. In fact, 2 of the 3 are headwinds. And rates are obviously not going to be the headwind they were last year, but they're not going to be the tailwind they were from 1982 to 2021, right? So, again, back to valuations. If you had a more rational valuation right now, I think you can make more bullish arguments that, hey, maybe the S&P can go from 15 to 19 times. Guess what? We already had that move. We went from 15.75 to 19 and change in a very short period of time, driven by arguably the narrowest market rally in history. That just doesn't bode well for future gains, and it means you have to be much more realistic with your expectations.
Troy Gayeski, you're sticking with us. Coming up, oil prices in focus after political instability in Russia.
some worries perhaps about supply. But this is a massive chess game, geopolitical chess game. I don't really think anyone really knows what the next move is going to be.
That conversation coming up next. From New York, this is Bloomberg.
We just have to admit that we don't know how Ukraine's going to work out and how that's going to affect the world. I mean, consider the possible ramifications of what could have happened this weekend, right? A political disarray in the Soviet Union, taking the third largest producer of crude oil in the world off the market, taking a large, dominant producer in major commodities off the market. These are events that, just on the economic side, could shake up the world economy substantially.
Commodity markets, meanwhile, breathing a sigh of relief after the Wagner Group called off a short-lived armed rebellion in Russia. The militia reportedly taking control of one of the southern cities where several oil and gas pipelines intersected. Here to take us through the ramifications is Bloomberg's Julia Fanzeres. Julia, what's the latest?
It's very clear that markets, if this were a normal market, would have rallied $1 to $3. But because sentiment, macroeconomic sentiment, is so low right now, markets aren't looking at geopolitics at the moment. They don't see supply being disrupted, and so they're going to wait for that to happen until something happens. It's very interesting seeing oil up 30 cents and not really caring as much about this move, even though we did have a pop earlier in the markets. But it's very interesting to see that macroeconomic sentiment keeps dampening all of the supply fundamental and geopolitic drama.
Julia, thank you so much, and truly an important update. You'll be updating us throughout the day. Back with us is Troy Gayeski of FS Investments. Troy, how much are you looking at commodities as a hedge against geopolitical risk versus something that could potentially continue to sell off if, say, the opposite happens and Ukraine gains headway and we end up unleashing some of the bottlenecks?
Yeah, I think the confusion level in commodities has really never been higher. On the one hand, you have obviously China's recovery is not going well at all. The U.S. consumer, isn't necessarily running on fumes because the labor market's still relatively strong, but, the clock is ticking on the strength of consumption. And then you have all the geopolitical cross-currents right now. So, again, one of the things that's nice about focus on, say, liquid multi-strategy funds or strategies that don't have that downside risk in a geopolitical storm is you can find other ways to eke out fairly consistent returns. You look at yield curve steepeners, they look attractive again. You look at the secular slowdown and refi activity driven by higher interest rates. There are ways that you can monetize much smaller inefficiencies in markets without having the gap risk to some disastrous outcome in Russia or a far darker outcome in China, right? I mean, you think about how fast that bullish argument's unwound. So yeah, from our perspective, commodities have strength. They have higher floors for sure, but it's a very dangerous game to play right now if you're going long oil based on the expectation of some type of geopolitical event.
Just quickly here, Troy, do you think that the commodity space, and oil in particular, has lost its position as a telltale sign on global growth, as a macro hedge against some clear global trend?
Yeah, it's much less clear now than it's been, you think back over 10, 20, 30 years, right? Because, and this has been one of our arguments why it's hard to understand why you could have a true super cycle in oil in particular, just given the electrification of the world. We've always thought copper made a lot more sense as a large, deep liquid commodity, because there you're going to have really relentless demand. Whereas on the oil side, you're going to continue to have demand destruction, or at least far less growth than you've had in prior cyclical upturns. And then geopolitically, it's very difficult to ascertain, which outcome would dramatically benefit you that isn't disastrous to other parts of your portfolio.
Troy Gayeski, thank you so much for your time, as always. Right now, let's take a look at some of the sector price action this morning. Let's get to Bloomberg's Abigail Doolittle.
Well, Lisa, when we go into the Bloomberg terminal and take a look at the IMAP, given the fact that we have this ever so slightly small gain right now for the S&P 500, we have more gainers than not for the S&P 500, but it's somewhat muted muted, the biggest gain being energy. Well, actually, that's not so muted, up 1.5%. Materials up 0.8%. Real estate industrials also up 0.7%. So I misspoke. There's actually some pretty solid gains to those sectors. On the downside, healthcare down about 1%. Consumer staples down about 0.6%. Net, though, overall, it's interesting, Lisa, the gain for the S&P 500 somewhat small, up about 0.3%. And it's going to be interesting to see whether or not last week, being the worst week for the S&P 500 since March, if we just shrug that off, or if there's going to be some kind of follow through on that selling action.
Abigail, thank you so much. Coming up, the market moving events that you need to be watching. That's next in our trading diary, as we do see a bit of strength as the session grows older. This is Bloomberg. Time now for the trading diary. What you need to be watching this week. President Biden discussing U.S. internet infrastructure at 11:45 a.m. Eastern. New home sales and U.S. consumer confidence coming on Tuesday. The Fed unveiling the results of its stress tests on Wednesday. Plus, we'll hear from central bankers at the ECB forum. And finally, U.S. GDP and jobless claims coming on Thursday. This was Countdown to the Open. This is Bloomberg.